It's funny, I have a recollection. I used to work with a lot of people in the social and digital space, and I remember what people thought about social media 10 years ago, and I went into a lot of rooms talking to business owners and I said, this is media, and they said, no, that's not media. Television is media, radio is media, newspapers are media, and it was 4 years after we'd reached that tipping point. I kept going, and they said, it's not media. Well, who can track these things? No one's talking about it. Somewhere along the line, social media was determining elections for countries. You go, I don't know what happened in the middle, but I'm watching this sort of thing play out again where, in the time it's taking people to say, I'm not convinced, it's too late. So, these are the opportunities that are presenting to us at the moment. Brings me to the conversation around superannuation and the next sort of, the next panel discussion, if we put that slide up. Although we're talking about the mainstream moment having occurred, the truth for me is when I think about the superannuation industry and the implications for the country, the importance of the superannuation industry in that context, they need to arrive, but I expect they will arrive last because this is effectively sovereign funds, people who are worried about their life savings. There's a natural conservatism that's going to be involved in the decisions that are made by superannuation funds. And part of the conversation today is to say, are we talking about it? Where are we? How are we having these conversations internally? Because at some point in time, again, much like the venture capital funds have in recent times where no one was interested and a few people were interested, and now everyone's interested. And the deal flow available to all the VC funds is not the deal flow available 3 months ago and 6 months ago, because when everyone shows up at once, there's not that much to go around. So I'll invite onto the stage Mark, Ryan and Seamus and have you talk a little bit about what this industry looks like now and some of the challenges and where we would hope and expect it goes to from here.
Thanks, Steve. We suitably got Seamus as last on the stage because superannuation's arriving last. First of all, I just want to apologise for lack of diversity on the stage. I know visibility is an important aspect of improving diversity in an industry, so we'll try and do better next time. So today we have Seamus Collins, immediately to my left, and he's the CIO, Chief Investment Officer of Mine Super, an industry fund for the mining industry, and I think that includes crypto mining as well, Seamus. It's a fund with over $12 billion in assets under management, and Seamus was formerly at JP Morgan and here in the ASX. And further to my left is Ryan McCall, who's a co-founder and CEO of Zerocap, a wholesale digital asset investment manager. He's been working in digital asset investment for around 10 years and has a background in technology as well, and Zerocap launched their first fund in September last year. So firstly, to frame the conversation, the superannuation sector, as Steve indicated, there are particular aspects to it that might make us the slower investors in this area. But there is $3.5 trillion in the Australian superannuation sector, and it's projected to surpass $9 trillion by 2041. But the compulsory nature of the system means that there's natural limitations and makes it a very heavily regulated industry. It also means that CIOs like Seamus have to deploy millions of dollars, in some cases with Australian super over $1 billion a month, as the money comes in from compulsory superannuation contributions. But funds are highly regulated because of its compulsory nature, because it's part of the government's retirement policies. It's a pillar of the retirement system policy, and so trustees are required to act prudently. They're heavily regulated, and I wouldn't be surprised if Seamus announced today that they were dropping $100 million into crypto. He'd probably be visited by at least 4 regulators on Monday. Not necessarily to say no, but really to ask him very detailed questions as to how. Now moving to Seamus, we'll just ask Seamus, can you tell us some of the challenges that the regulatory framework creates for superannuation funds investing in digital assets?
Thank you. Thank you, Mark. You're quite right. Superannuation is an industry that's highly conscious of the responsibility of the broad community's investment savings. It's a long-term, most people have a 40-year investment horizon, and so it's tends to be around incremental growth rather than hitting it out of the park. And I would like to say that, in terms of the regulatory framework, it never precludes an investor like myself and my fund from investing in innovative or forward-thinking assets, but it's highly prescriptive in what is expected of our fund and its executives and board in how they do that and how they justify that case. So there's 3 areas I wanted to touch on a little bit around engaging with crypto, but it would apply equally to any new asset class. And the first one is really at the heart of it, which is trustee obligation, the fiduciary responsibilities they have. And that is really clear. It's not a grey area at all, that they need to be prudent, they need to have very strong governance, and ultimately they're on the hook. They can rely on experts. In fact, my fund, we utilise around 70 asset managers who provide their domain expertise across a range of different investment classes, and certainly we rely on them, but ultimately the trustee is on the hook. What does that mean? That means before we engage with a new investment class, there's a process of familiarisation, education, understanding, and ultimately investment. So the investment does come last as that process goes through till you get to a point where the trustees are happy, given that legal obligation, to commit their members' money to that investment. The second aspect is the guidelines and requirements around governance, and they're also quite strong. So before I can recommend an investment to my investment committee and board, I need to be able to demonstrate to them a really strong underlying model for the return expectations. We need to publish our return objectives publicly. We also need to publish risk metrics. So we need to understand and be able to model what our expected downside risk is over a 20-year period, what drives the kind of volatility amplitude. And I think that's probably a challenge with newer asset classes. So for a lot of traditional asset classes, we rely on decades and decades of history and return and risk outcomes that you can model through all sorts of scenarios. So in most of our traditional asset classes, we will model debt crises, global financial crisis, the tech bubble in 2000, the recent pandemic, going back to the 80s or even further, so we can give our trustees a reasonable expectation that given events, given shocks, given economic activity, they can have a reasonable understanding of how they can expect their investments to respond. This stress testing process is mandated by APRA. So, in order to stress test these events, we rely on that really deep history. The other aspect of the investment governance process is due diligence and the questions we need to ask and the comfort we need to get around the infrastructure, the laws, the security of an asset class and how we invest in it. We'll go through that a little later. And the last aspect is obviously what is good performance? I mean, this has been a really big topic for the superannuation industry. It used to be that the super industry 10, 20 years ago, it was relatively small, had a lot less focus, and it used to be more innovative. It wasn't always the behemoth that was last to the investment opportunity. Super funds invested in copyright, they invested in fine art, they invested in wine in some cases. The institutional industry and a lot in startup, venture capital, in university incubators. Over more recent years, we've seen that innovation narrow. Part of that's because the funds are so large that they've just outgrown some of those smaller opportunities and that nimble. They need to get set at scale. And obviously with new asset classes, it's hard to deploy at scale from day one. So that's the first challenge. The second challenge is essentially there's now a definition of what performance looks like. The regulator has published a benchmark. It's predominantly constructed of traditional asset classes, and you need to outperform that benchmark. And if you don't, you need to advise your investors that you're an underperforming fund. And obviously, that places a great deal of stress on your organisation, on its future, and on the fund. For new asset classes, they're by and large not covered by that benchmark. So to the degree that you invest in new asset classes or innovation, you're taking significant risk against what good performance looks like. And if that risk doesn't play out against a traditional asset class, you're held to account. And obviously our trustees and our industry are highly aware of that. And so it can still be innovative. You can still invest in new assets, but the accountability and the risk, if those don't play out, are very real and very significant.
Thanks, Seamus. Just in case the regulator APRA is in the room, I'll point out it was the minister that was here formerly who set the benchmark, and APRA just applies it. But they'll be sensitive to that. I'm not sure no one else is. But now we're just going to do a little role play where Ryan's going to play the specialist asset manager, which he is, and Seamus is going to do some due diligence on some of those questions that a super fund would ask. So let's see how this goes.
You know, Mike Novogratz was speaking before, and if he hasn't been able to convince the audience that you should be investing in crypto, I've got no hope.
Let's give it a go.
No, thank you, Mark. I think, and we've had obviously a lot of good discussions about this, but the key thing my investment committee wants to understand is what is the driver of value appreciation? So most of our assets are explicitly or indirectly linked to fundamental underlying GDP or economic growth. I think the key thing they come to me when I talk to them about this space is, Seamus, what is the growth driver, the income driver or the appreciation driver for the investment? How do we understand how over 10, 20, 30, 40 years this is going to add value over the long term?
Okay. So it is a difficult question to answer, but I think a useful model for the valuation of Bitcoin and other crypto assets, you can look at Metcalfe's law, which is, it doesn't apply perfectly, but it's a useful proxy, which basically says that the value of a network is proportional to the number of users squared. And that's a model that's been applied to tech companies, right? So you can look at a marketplace like eBay. It increases in value the more buyers and sellers or products that are actually listed. You look at Uber, it becomes more valuable as you've got more drivers and more passengers that are looking to hail Ubers, right? And I think another really good analogy is the internet. And a lot of the trends that we're seeing in cryptocurrency are very similar to the early days or the formation of the internet kind of going mainstream. So we could create a new version of the internet, and it would just be the three of us here, and it might be useful to us, but it's not useful to anyone else. That network can grow and include everyone in the room, and it has more value now because there's more people participating in it that can exchange information, and you can play that out all of Australia or globally. So you look at the internet, and basically everyone in the world is connected, and that inherently has value. And I think it's a good analogy for a couple of reasons. Another one being, we sometimes hear the argument that Bitcoin's really slow or it's expensive or whatever you might say about it. And, we could create another version of the internet. We could create another version of Bitcoin or whatever protocol it is that we're talking about. But if no one's using it, it doesn't inherently have any value. So I think those network effects basically are really what's driving the value of a lot of cryptocurrencies. And then there's also portfolio benefits, right? Diversification, hedge against inflation, that sort of thing, which we can get into.
Yeah, do you think that network effect is now irreversible? It's now reached a level of maturity where it is something we can bank on?
Yeah, I do. You look at, there's 100,000 Bitcoin nodes running around the world. Now you've got governments and regulators that are paying attention to what's going on here and forming policy. We're having conferences with CIOs of superannuation funds that are speaking here. So, there's just so much momentum behind this now. I think, there's no putting this back in the box.
Yeah, I think the first thing, and thank you for that, Ryan, is the economic driver. And you're right, you touched on inflation. I think that's really important for us. We have, I think, historically looked at crypto and does it have a role as a hedge instrument or a store of value that's uncorrelated and diversified? And I think absolutely I think, you can certainly make that case. The network, I think, gives us our economic growth, i.e. it's linked to the network growth, which I think terrific. How do I talk to my board and committee around, I think the nuts and bolts of investment, which are asset security, custody, regulatory compliance, money laundering, counter-terrorist financing, those kind of aspects, because I think Mark touched on how regulated we are. Super funds have virtually zero appetite for taking risk in the regulatory space. And so it can be quite hard where we don't see a really, really bulletproof story around compliance, asset substantiation, security, and custody structures.
Okay, so there's quite a lot of stuff there, but let's start with, what was it, like counterparty risk and the security of the asset. So I guess this applies to, most of the topics that you touched on there. Like, the industry is moving so fast. There's been so much change just over the last 12 months alone that we can do things now that we weren't able to do, until relatively recently. So there is a lot of different custody technology providers that are out there, Fireblocks, Copper, Ledger, there are others that have taken models from traditional custody and applied them to this new asset class. But there's also a role for custodians to play in that. So technology is one part of it, but then there's actually the responsible custodian. There are a number of these out there already. The regulation around that is a little bit grey, and that's been spoken about a bit today, so that regulation is on the way. But one of the things about the industry is all the participants really hold themselves to an extremely high standard of governance and due diligence. All the exchanges and digital asset custodians that are already operating, and I think have all the risk management protocols and controls in place that could be demonstrated to, an investment committee that was going through their due diligence. Whether that's sufficient enough or not, you'll have to tell me. So does it have to be regulated before it actually gets that tick?
It's a great question, Ryan, and it would be very hard for a super fund. It would be, from Yes Minister, it would be a very courageous decision to invest in an unregulated asset class. And I think you've touched on the core step that super funds need to take, because you're moving from a scenario where you're essentially residing your asset risk and structures and your directors' legal liability from the regulatory and legal structure into something that has some legal structures and regulatory things, but also has a very strong technology and algorithm kind of structure built into it. And so it's how do we get, my board to get comfortable around the role that the blockchain itself is playing in regulating the validity of transactions, the industry, and their asset holding. And I think that's possible. I think we may not be last. I think we'll probably certainly be more in the middle to the back of the pack. And I think it's a degree to how the industry kind of self-regulates that you start getting the superannuation industry. I mean, the superannuation industry does think in long terms. We do engage heavily with long-term infrastructure and development projects. And I'm certainly conscious that if we don't engage in this, we may miss something that's critically important over the long term. So certainly that's important. I think the degree to which, or the velocity to which we do so, will be how we get some of those aspects you talked about, like the counterparty risk. I have to be aware of where my money's going. I can't. So that's something that we talk about a lot, is the level of anonymity and counterparty disclosure. As a super fund, I can't afford not to know where my investment dollars end up. I mean, it's absolutely that scenario where banks end up funding illicit activity in the emerging world is just a risk appetite that trustees is absolutely zero. And so you and I talked a little bit about the creation of the kind of more clean crypto or secure crypto, and I think that was something that I found interesting.
Sure. Yeah, I mean, just quickly on counterparties, now there are big institutional counterparties in the space, many, many billions of dollars on the balance sheet. So there are counterparties that you can trust. On the AML side of things as well, which you touched on, like that's another area where technology has now come so far that we can get a really good read on the flow of funds and has it gone through any nefarious sources, criminal activity and that sort of thing. And, banks and regulators are now adopting this software. It's sort of becoming the pseudo standard, which I think I think it's possible that technology will actually inform or influence how KYC and AML and whatnot is done in the traditional space. The point that you just touched on there about will we end up with almost like two economies, two digital economies, right? Where there are clean coins and dirty coins, basically. So assets that we know have not passed through, whether it's a dark web or whatever it might be, and they're assets that have. Like ultimately, it'll be up to compliance and risk teams at large institutions to decide how important that is. But I could totally see a world where there is a premium on those clean assets.
And volatility, was that an issue for you, Seamus?
Volatility is a terrific point. My fund has an explicit objective to provide peace of mind on the journey. So we do have a purpose of providing a retirement outcome that gives people comfort in retirement. We're a blue-collar fund. That's really important to us. But it's also important that that peace of mind along the way does give us a level of implicit or actually explicit intolerance for volatility. I think that can be managed with the sizing. So I think the current volatility for us means that it mitigates against a large or a material portion of our fund, because the volatility, we can't have that volatility playing through in the whole fund. But once we understand better how the volatility interfaces with our other asset classes, that's how we manage volatility, through the correlations between asset classes. And I think having the research and the asset management skills and advisors to support a super fund, I don't think the volatility is in and of itself precludes investment, but it perhaps precludes a large investment.
I will just say quickly as well, I know we're going to get the wrap up, but like now derivative markets have overtaken spot markets in terms of volume. Like I think that happened around the middle of last year. So there are ways to alter the risk profile of the asset. So position sizing is definitely one way to control the volatility, but there are now, options in futures markets and whatnot that can do that as well. And there's active strategies as well. Like one of the funds that we have, you can rebalance between Bitcoin and a stable coin, right? So when Bitcoin is more volatile, move more into cash. When it's less volatile, move more into Bitcoin. And effectively what that does is compresses the volatility of the asset to match that of equity markets, which you're comfortable in investing in.
Fantastic. That is, we are at time. Ryan and Seamus, thank you so much. And I'll just leave it at, we're going to take this conversation offline.